Hello and welcome to this special edition of Money, Money, Money Commonwealth Gold with CNBC TV 18. I'm Sumaira Abdi. Ahead of the start of the Commonwealth Games on the 28th of July, CNBC TV 18 has undertaken a special mission of financial fitness. So just like the Games demand absolute physical fitness, similarly for financial wellness too, one needs to stay prudent about one's financial goals and fitness levels. So joining me in this endeavor today is Kirtan Shah, founder and CEO of Credence Wealth Advisors. Kirtan, thanks very much for joining in. And the topic we thought we'll discuss today are some of the common money mistakes that people make and how you can avoid it. So Kirtan, thanks very much for joining in. And I want to begin with what is probably the biggest stumbling ground, which is life insurance itself.
Sumera, thank you so much for having me on the show. Sumera, I think the biggest mistake that all of us as investors typically end up doing is, choosing investment planning over risk management. I think investment planning comes second in the scheme of things while you are trying to do your personal finance, and risk management does not really get the kind of respect that it deserves. So I'm glad that we are starting with risk management. I think in life insurance, the first thing that a lot of us, kind of get confused about is there are so many of these options available. Which one should we really end up choosing while we are talking about life insurance? And the answer to that question is very simple, in my opinion. All you have to do in life insurance is just take term insurance. There is nothing else, in my opinion, in the entire ecosystem around insurance that can add any value to what is not available outside except term insurance. So as an investor, I think the first thing that you should do is have a term insurance in place. The second question that we typically get asked is, how much of a term insurance should I really have? Now, ideally, there is a systematic process to figure out what kind of term insurance do you need and which is called human life value. But I think largely, if you take anywhere between 10 to 15, 20 times of your annual income, that should be good enough for you to start off with the right kind of value for term insurance. But always make sure that while you are trying to apply for an insurance, do not make the common mistake that a lot of us typically do is not disclosing the correct things, right? So very specifically disclosing that whether or not you smoke or have alcohol or have any pre-existing diseases is extremely important, in my opinion, to disclose while you're talking about life insurance. So yeah, three things: take term insurance 10 to 15 times of your annual salary, and make sure that you've disclosed everything that you know of.
And it's not just term plans, right? I mean, sorry, there are some kinds of term plans also, I guess, where you have to be careful. But, I wish we could have covered that today. But Kirtan has agreed to join us again next Monday to talk about that in greater detail. So we'll take that up next week. But Kirtan, for now, let's stick to the common money mistakes. And we spoke about life insurance, and now you can't leave behind health insurance, can you?
Oh, absolutely not. I think it's a must have. A lot of us typically feel that because we are corporate employees and largely we are covered under some or the other plan that the corporate has. I think one real understanding that I'm sure a lot of us got during the COVID times or otherwise also, that you can't really depend only on the corporate health insurance that your employer provides. So in my opinion, the first thing that you need to do is even if you have a corporate health insurance by your employer, make sure that you have another one. And while you're trying to have this another one, like in term insurance, always make sure that you disclosed everything that you need to disclose before you actually get on board with the health insurance that you are really looking for. One last thing that I also wish to mention here is that there are certain kind of products and policies that you might end up taking which might not cover 100% of the expenses that have happened while you've hospitalized or otherwise. So always try and make sure that you have a small portion kept aside as contingency for medical related problems, because even when you might have the required covered, right, but not everything during hospitalization is actually covered, and this probable small contingency might help you in that regard. So.
Okay. And of course, through the entire pandemic, one of the things which has come to the fore is that people didn't have adequate emergency funds available. So, what is going wrong over here, and how do we set it right?
So, like we said that risk management is more important than investment, right? After you've made sure that you have your life and health insurance in place, Sumera, I think it's extremely important to make sure that you have your contingency also in place. Like you rightly pointed out, we saw what happened in pandemic. People lost jobs, and while they lost job before they could find another job, I think there was a big lag between finding another job and making sure that your household expenses are taken care of. I think taking a cue from that, we have to always make sure that we at least have 6 to 12 months of our monthly expenses kept aside, either in a savings account or liquid fund of a mutual fund, to make sure that if there are some unforeseen events that happen in the future, we at least have something to rely back on for 6 to 12 months. In the meanwhile, we set the course correct. So make sure that all your living expenses, including your EMI, into 6 to 12 months is what you should have as contingency, kept either in your savings account or liquid fund on the mutual fund side to be the best part of it.
Okay. And what is the most common mistake that people make when they're setting their goals, or in some cases, not setting goals?
So Sumera, while we talk about investment I think is largely very erratic, impulsive. Most of us think that we want to invest, so we look at how much money do we really have today, and we start investing. I think the first thing that we should really try and do while we are looking at investing is set a goal. And while we are trying to set a goal, there are 2, 3 things really to look at. First is you have to make sure that your goal is realistic. A lot of us would want to achieve very extraordinary things in life, and that should be a good way to look at things. But in my opinion, largely we should be very realistic while we are trying to set a goal. Also, while we are trying to set a goal, I think it's very important that we have a clear timeline as to when are we really looking at achieving these goals. Because in my opinion, once if we don't really have the timeline, we will not get the correct output on how much do we really have to invest to make sure that we end up reaching that goal. And also, in my opinion, if we really have a goal, I think it brings in more discipline to our overall investing opportunity. But having said all of these things, I think the most missed out of all of these things that people do while they are doing goal-based planning is not looking at inflation while they are trying to pick a goal. So what I mean by that is, let's say if we are planning for child's education, and the child education is going to happen 15 years from later, you cannot plan your finances looking at the amount of money that could be required as of today. So let's say if, as of today, you are going to spend 10 lakh rupees for that particular goal, you might have to end up saving much more than 10 lakh rupees, because your goal after 15 years is going to be much expensive than today because of inflation. So while you're trying to do goal-based planning, always make sure that you take into consideration inflation, and hence a higher number that you would require in the future while you're trying to do a goal-based planning scenario.
Okay, fair enough. And how much of a mistake is it to start late?
I think this is the most spoken about discussion on probably all chat shows or social media, which is the power of compounding, right? I think it only becomes difficult while we are trying to start investing at any point in time, right? But of course, having said that, the more you push your investment to a later date, I think the more difficult it becomes, because the amount of money that you will require to reach the same goal is going to be much higher. So to give you an example, let's say if you're looking at accumulating 5 crore rupees at 60, right? And assumption is that you will be able to make 10% on your investments, right? Now, if you start investing when you are 25, which means you have 35 years to achieve 5 crore, the SIP that you require is roughly 15,000 rupees. But let's say you delay your investment by 10 years, and instead of starting at 25, you start investing at 35, then your SIP requirement moves from 15,000 to 40,000, right? For the same goal of 5 crore rupees that you want at the end of the 60th year. So every delay that you do in your investing is going to cost you in terms of a higher savings rate, right? In this case, we saw how delaying it by just 10 years, the savings rate actually went up 2.5 times. So it is sacrosanct in my understanding that if you are clear, you have investable surplus, start investing whenever that is, because every delay that you do in your investment is going to cost you a very high savings rate.
All right, fair enough, Kirtan. We're going to take a very quick break now, but there are some more, common money mistakes that Kirtan's going to highlight when we return. So do stay tuned, and we'll be right back. Hi, welcome back. You're watching Money, Money, Money. Kirtan Shah of Credence Wealth is still with us, and he's talking about financial fitness today. What are the common money mistakes that you can avoid, and how to basically go about it. So, Kirtan, we've spoken about 5 top rules. Next, any golden rules that people should be looking at, particularly with respect to asset allocation?
So, Sumera, while I talk to a lot of people in general, one very prominent thing that I always get stuck on is that a lot of people come back and say that they are not very sure of whether they are investing enough or not, right? So, everybody might make X amount of money, but how much of that X should actually get invested is something that a lot of people have a question around. So, of course, it's needless to say that while you are trying to invest money, make sure that you don't put all your eggs in one basket. Don't try and invest everything into one asset class. Always maintain an asset allocation. Do not try and time market. But I think more importantly, what I really want to highlight for investors here is how do you decide whether or not you are investing enough? So I follow a very simple rule of 30, 30, 30, 10. What I mean by that is that if your income is 100 rupees, make sure that the maximum EMIs that you end up spending for everything that you buy on EMI is not more than 30 rupees. So 30% EMI, maximum household expenses should not increase more than 30%. The 30% remaining should go to savings and 10% to liquidity. What I mean by here is that let's say, for example, if you don't run an EMI, you are young, right? That means you can take that 30% which was supposed to go towards AMI and club that to savings, which means you will do at least 60% of savings and 10% liquidity. So out of 100 rupees that you make, 70 rupees has to get invested in some or the other way, and only 30 rupees would typically end up getting spent. I think this is one very important data point that investors should definitely keep in mind, in my opinion, because a lot of us, largely in spite of making a lot of money, end up under saving.
Okay. What about equity investing? I mean, I can imagine that there would be any kind of things we're doing wrong. So, what is it that stands out to you?
I think, Sumaira, first, while we are trying to do equity investing, there is nothing like get rich overnight scheme. And I think that is something that investors have to understand. In this social media influence led world, it's easy to believe that you can double your money every month or every year. It does not happen like that. Equity is a long term investment product, and it should be given respect in that sense, in my opinion. Right. Also, what is very important is you should try and make sure that you don't invest in any product that you don't understand, because the more the complicated the product is, the more it'll make sure that you have sleepless nights. Do not do that. And also, very specifically, thanks to social media, it's become so easy to convince somebody that, doing options or doing futures, it's easy to make 1, 2, 3, 5% every week. Life is not that simple. Try and avoid FNO if you really don't understand how to do it. And lastly, while we talk about equities, I think what I really want to convey is that investing is what will make you wealth and not trading. So trading may make you cash flows, but it will not never make you wealthy. Investing is what will make you wealthy. So if you've avoided all of these things, and if you don't know equities directly, I mean, if you're not somebody who understands when to pick what stock, when to exit, you should stick to a mutual fund kind of a product where there is a fund manager who takes those calls on your behalf.
Okay, so just like investing, what about fixed income then?
I think, Sumaira, the biggest mistake I think all of us make is go by its name, which is fixed income. Nothing, in my opinion, in fixed income is actually fixed. It's a misconception that fixed income is risk free, right? But having said that, I would largely like to believe that if you have 3 years and more of investment horizon, a debt mutual fund would do much better than probably doing a fixed deposit. Because while you are trying to do a fixed deposit, all of us feel that there are no risks, but there are multiple risks while you are trying to invest in a fixed deposit also, right? Risk is that fixed deposit will have a lock-in, and if you try and remove before that lock-in, you will be charged a penalty. That's liquidity risk. Your fixed deposit might not be able to generate more than inflation returns for you. Tax is very high. There are multiple of these other risks around fixed income, but we only look at whether I will get my money back or not and default as a risk. I think if you have 3 years and more of investment horizon, debt mutual funds definitely can add a lot of value, is because tax works very swiftly in favor of debt mutual funds. Because let's say if your debt mutual fund makes 8% returns, and if inflation over that 3 years has been 5%, irrespective of whatever your marginal tax rate is, you still end up paying 20% on the 3%, which is 0.6, right? So on 8%, if you pay 0.6%, you actually make 7.2% net in hand kind of returns. And I think that's brilliant versus a fixed deposit kind of a product. But having said all of these things, what all investors have to predominantly understand is that if any fixed income product is paying you higher returns, there is definitely a high degree of risk. All that you have to understand is whether you're okay taking that risk or not.
Okay, while we're talking about different asset classes, what about real estate? Because this is a favorite of Indians. Where are we going wrong?
So I think, look, Sumaira, if I theoretically tell you and talk about financial models, anybody who does a little bit of Excel number crunching will tell you it makes no sense to buy a real estate. You might as well end up renting it, right? Is because while you are trying to do real estate investing, the first thing that we have to understand is extremely illiquid. Second, if you look at rents that the real estate may earn you on the residential side is 1.5%, 2%, right? Maybe commercial real estate might make you 6-7%, but residential is 2% or 2.5, 3% on a higher side. So on a 1 crore property, I think at a 20,000 rupee month uh, rent, you probably might be able to stay in that apartment. But if you have to end up taking or buying that apartment, you will have to take a 6.5, 7% loan to take the same apartment, right? And also, what largely, of course, this is slightly more sophisticated, and it does not involve a lot of emotions. And everybody from us would want to own a house. But if you purely look at numbers will largely tell you that real estate investing does not make a lot of sense. Yes, you might have one house for your own self, but please do not understand that that house is available or that house is an investment, because whenever you would need that money, you are never going to be able to sell that house because you stay in that house. I think while you're trying to do real estate investing, REIT is a very interesting way to invest in real estate.
Okay, fair enough. Finally, what about gold then?
So, Sumera, gold again, like I said, that while you're trying to do gold investing, I rather believe that doing capital market related investing in gold makes a lot of sense versus doing physical gold, right? And even if you're trying to do physical gold, it is worthless doing a jewelry invest in. You might as well rather invest in gold bars, is because while you're trying to do jewelry, you are going to end up paying making cost, which is not going to be available to you while you're trying to sell that. But having said that, I don't really think investing in physical gold makes a lot of sense, is because you end up paying GST. There is a lot of difference in the pricing while you are trying to buy and sell. There's opportunity to cheat. You don't know where do you save that, and there's an opportunity for theft. I think while you're trying to do gold investing, the best way, in my opinion, to invest in gold is largely either do a sovereign gold bond, which the government of India offers, or do a gold ETF. So a capital market investing route in gold makes a lot of sense, in my opinion, than doing physical gold.
Okay, Kirtan, looks like we have time for one more. So I'm going to ask you about tax planning.
I think, Sumera, so ideally, while there are a lot of things to look at in tax, but in personal finance, one very important thing that you cannot miss out on is your ATC, right? So you are allowed to invest up to 1,50,000 rupees in some products, where if you invest in those products, 1,50,000 becomes deductible, and you can end up saving 45,000 rupees as tax if you are in the 30% tax bracket. Now, I've seen a lot of us make this mistake that to claim ATC advantage, we end up investing in a 5-year fixed deposit or end up taking insurance. You need not invest in either of these products to claim ATC. You can very easily do a PPF, you can do an ELSS in a mutual fund, and also a lot of employers deduct EPF and all of these things, which are a part of the ATC. Or if you run a home loan, right, the EMIs that you pay, certain portion of that is also a part of ATC. So while you're trying to do ATC investment, don't get carried away doing bank fixed deposits and insurance to claim that ATC. You have multiple other options, like I listed out, which are far better as an investment option, in my opinion, while you're trying to do ATC. Of course, along with ATC, you can do ATP, which is Mediclaim, health insurance, and various other things. But I think ATC is something that you can't really miss out on.
All right, Kirtan, for now, thanks very much for joining us in this special edition of Money, Money, Money. And we'll see you again next week and talk about term plans. With that, we'll wind up. Thank you very much for watching.